Hey, what's going on, everybody? This is Trader Jeff Moore, author of the book Trading Part-Time, CEO, lead instructor of the Trading Part-Time University. And in this video lesson, I'm going to continue my discussion on options. We're going to talk about the option chain, the leverage that options provide. I'm going to explain why a lot of people will choose options instead of stocks because of the leverage. And we're also going to start talking about the Greeks, delta, theta, vega, gamma. What are the Greeks and why they matter? We're going to talk about all of this in this training video lesson. So sit back and enjoy this lesson.
All right, so what we're going to do today is, well, first we'll do kind of a recap for what we talked about last week in the basic option class. We really introduced a lot of stuff, okay? We talked about, what are the importance of options, why do we use options, and one of the main reasons we use options is for leverage, right? Because if I wanted to buy, let's say here, if I wanted to buy, let's go to JP Morgan. Since I bank at JP Morgan, I'd like to take their money. Okay, so if I'm going to buy JP Morgan, it's $108, and right here, pull out my annotations, get this bad boy up. Remember the bid ask. So let me see here. Who is the brave soul? When we buy a stock or an option, do we buy on the bid or do we buy on the ask? Ask, right? Rafa? Ask. Everybody else agree? We buy on the ask? Ask. Good. Yeah, we buy on the ask. Right here, so it's $107.99. We're going to leave it at that, $107.99. So, remember, let me write that down because my memory's not very good. As you get older, you lose that memory. $107.98 now. All right, hey, Janie, how's it going, girl? Okay, so if we remember J.P. Morgan, so we have a choice. We can buy J.P. Morgan, right? And the price per share is $107.98. No big deal. So if I wanted to buy 100 shares of JP Morgan, and the reason why I buy 100 shares is because as you start to advance in your option trading, you'll learn things like covered calls, protective puts, and you need, Jeff, can you send me the link again on my phone? I don't have it. Hang on. I don't like this. All right. So, $107.98. If I wanted to buy 100 shares, then I buy 100 shares because, again, it allows me to do option strategies around my shares. Okay, here we go. 100 shares times 107.98. It's going to cost me people keep messaging me. $10,798, right? Let me invite some people. Hey, George, let me invite some people really quick. Invite. Okay, so DLM, sorry guys, boss at AOL.com. And yeah, bus invite. Hey, George, how's it going, brother? Sorry, guys, but this is why we got to log in early. If there's problems, we got to get in early because it messes up everybody. And I don't understand why people have problems logging in. It's not hard. Right? All right, everybody. Okay, so let me just finish this up real quick. In Jean, E-T-T-E-E, Liza, L-D-E at Gmail. Okay. Just sent the link. Okay. Doesn't this look exactly? Okay. So anyway, I just emailed. Okay. Well, we got triggered out. All right. So we collected $400 profit on that trade. All right, Dan. All right, Anjanette. Okay, here we go. So back to our discussion. So let me just mark up my other chart I got, which y'all can't see. Okay. So here we go. So again, if I was going to buy JP Morgan, $107.98 is the share. If I bought 100 shares at $107.98, it's going to cost me $10,000 to buy 100 shares. So if I'm going to do JP Morgan and option price Okay, option price, if we go back over here to the paper money, and let's go here to this 45 days. We'll talk about that today as well. What I'm going to look at is this first strike. It's called out of the money. And I'll also talk about out of the money today. Okay? Make sure everybody's chat's on mute. Good. Okay, and it's 2.68. We'll leave it at that. 2.68. 2.68. So I don't want to forget it. 2.68. Okay. So the option price is 2.68. For those of you that attended on Monday's lesson or watched the recording, how much money would it cost me if I bought that option price? 2.68. What does that mean? How much money is that? For those of you that attended Tuesday or watched the recording. 268. 268. Absolutely. It's going to cost me 268. So, one thing about the option price is you control 100 shares. So, if I buy JP Morgan for 100 shares, I physically have to come out of my pocket $10,798. If I want to control 100 shares, which again, it's still 100 shares, then I'm going to pay, control 100 shares. I don't have the times to buy nothing. It's just $268. Okay? $268 because if I go right here and I click right there and I go, now it's 272, but let's say it was 268 because that's what it was. I hit confirm. There you go. Maximum loss, 268. So one of the beautiful things about trading options is options have a defined risk. Okay? Options have a defined, and Jeanette, connect to the audio. Connect to the audio. Connect to the audio. And, okay. All right. So they have a defined risk. That's beautiful. So no matter what, I know that the most that I can lose in this trade, even if JP Morgan, Chase Bank, goes to zero. So would you rather pay $10,798 or would you rather pay $268? That is a dumb question. I'm pretty sure that's a dumb question, but I would probably say that every single person here would rather pay that. That is the leverage, right? That's the beautiful thing of options. They allow you to control 100 shares per option. So here's the deal. Let's say that I was willing to risk. I was willing to risk $1,000 on this trade. I was willing to risk $1,000 on this trade. So, let's see here. If I was willing to risk $1,000 on this trade, how many option contracts could I buy? Hey, Cherie. 3. Let's see. We're going to take $1,000 and we're going to divide it by 268, and that's going to equal, I got my calculator. Always, one of the things I'll let you know, guys, is when you're trading stocks, you're trading options, you're trading the Forex market, always have your calculator on hand. Always. Somebody type in how Anjanette seems to be having problems logging in or for the sound. Maybe somebody can type into the chat for her, for the sound. She seems to be having issues. So, 1,000 divided by 68. Let's see if George is right. So, 1,000 divided by 268 equals 3.73. And George, you are learning good, my friend. We always round down. So that is 3 contracts. That's what I'm going to buy. So 3 contracts allows me to control 3 contracts, right? Means that I'm controlling 300 shares. So, and if I buy 3 contracts at $268 per contract, I'm investing in this trade a total of $804. $804. So let's see here. Let's think about that for a minute. So I can pay $10,798, right? $10,798 to control 100 shares. So if the price of the stock of JP Morgan goes from $107.98 to $108.98, that's a $1 move. If I have 100 shares, I make $100, right? So I'm putting up $10,798. So if I put up $804, and the price moves up $1, you'll see in a minute when we talk about the Greeks, my option is going to probably double in price. So I'll probably be at 100%, and I'll show you how we calculate that here in a minute. But the first step is, why do people trade options? They trade options because would you rather pay $10,798 for 100 shares, or in this case, if I was willing to risk $1,000, buy 3 option contracts and control 300 shares? That's the beauty. That's the beauty. So if we go take a look at JP Morgan's chart, we go over here. I like using the profit chart for that. JP Morgan's chart. That's a big mess, okay? We're going to design. I'm going to show you guys how to set up everything. But again, if we look at the hard right edge, again, for those of you in the advanced technical analysis class, you've got a low, you've got a lower low, you've got a high, right? You've got, now there's no high here because it hasn't rolled over. So what I would do in that case is I go here, and this is my resistance. And how funny is that? Look at that. Price literally, this is not by accident. Price literally went to the resistance. Look at that. Twice, which means they're fighting it at that level. Okay? So I look at JP Morgan's chart, and one of the setups that I'm going to teach you guys, not yet, but in the advanced technical analysis class, is a setup called a breakout. Right now you trade bull flags. And bull flag entries are what's called bounce entries. Okay? Bounce entries. So we have 2 order entries. We have breakout entries and we have bounce entries. Okay? A bounce entry is like this. Price goes up, pulls back. Let me change my color so we can visually see it. Bounces, right? Price goes up, bounces. That's a bounce entry. But the next entry is breakout. So I haven't talked to you guys about breakout entries, okay? But a breakout entry is whenever it clears the resistance. It's called a breakout. We have techniques for measuring price targets and everything as well. So just kind of wanted to point that out. So if I was looking at JP Morgan Chase, I would not enter this trade yet. But again, I would trade the patterns, and then I'll teach you how to, trade it via the options. But that's the first thing I wanted to point out. That's kind of a recap. If you have not watched the recording, make sure you do watch the recording from last Tuesday's class because it was incredible, and today might not make as much sense without it. Okay, so now let's look at this big, bad, scary option chain. Okay, when it comes to options, this is where, again, I'm going to do my best to explain. I didn't think I'd be having to explain options. I'm always trading by myself. I never thought I'd really sit down and teach somebody else. So I'm going to do the best I can to explain it. So remember, if you have any questions on this, you can post some questions here. We'll answer some questions. But also Fridays are our online coachings, and that's where you're, really designed to ask questions. But again, I can answer some questions here because, again, we have an hour together, and we'll do the best we can. So if you do, that's fine. I'll follow my agenda, and I'll try to get to your questions if we have it. So here we go. All right. So if we look at this big, bad, scary option chain, does this look intimidating to anybody? Does this look intimidating to anybody right here? Type in the chat. When you first open this up, does this look scary? Yes. Be honest. Every one of you, be honest. It scared the crap out of me. Yes, yep. It looks absolutely freaky. Okay, and Jeanette, when you first log in, there's a drop menu where you choose your option. You need to click OK. Thank you. Gotcha. You can hear though now, right, Anjanette? Anjanette, type in if you can hear me. Type in if you can hear me and Jeanette. Can you hear me? Hang on. Yes, okay, good. Okay, good. Thanks for that tip and the message. Okay, but yeah, it's a big bad scary option chain. So let's dissect this bad boy, okay? Because it's not scary to me at all. I actually love it. It's like music. So here we go. The first thing we look at when I look at JP Morgan. Now, I trade JP Morgan. For those of you in my stocks class, hopefully you're building your watch list that we discussed yesterday. Because if you're not building your watch list that we talked about yesterday, then shame on you. You probably don't really want to be good at trading. Okay, because that's a serious issue. Build the watch list. Don't mess around. And if you didn't watch the class, go watch the class. Okay, and so we're looking at JP Morgan. I'm going to look over here. Now, I see the JP Morgan right now, and if you look down here, it's only 9:49 in the morning. So the market has literally not even been open 1 hour and a half. And it's already traded 2 million shares. So when I look at a stock, when people tell me, hey, have you looked, this stock, this stock, I don't presume any stock's bad or good, but the first thing I do is I go check out the volume. I want to see what the volume is. Now, when I trade options, I'll be dead honest with you. I focus on stocks that trade over 5 million shares a day on average. 5 million shares. So if somebody gives me a stock and there's only 300,000 shares that are traded, there's no way in the history of the world that I'm going to trade options. Now, let's see it. This is participation from the last class. Why do you think I trade stocks that have such a big volume when it comes to options? Why do y'all think? Let's see if I did a good job explaining last week. So you can sell out. Like this, you can sell out. Get out. To reduce the spread, tighter spread, liquidity. Man, you guys are fantastic. Either y'all are fantastic or I'm actually just doing a good job, or both. Probably both. Yes, the answer is for both liquidity and the spread, because this right here, the bid, just like stocks, is the sell. Ask is the buy. Ask. Do you see this right here? 108.66, 108.67. That spread is 1 penny. 1 penny. So if I buy, I'm only going to be losing 1 penny. That is why I trade highly liquid. But the option chains are a little different. We look here and we look here. So if I look at this first strike, out of the money, and I'll try to get to today explain what out of the money, in the money is, so you guys can understand, because this is just might be foreign. 293 is the asking price. 288 is the bid price. So that is a difference of 5 cents or $5. Do y'all think that's good? Do y'all think 5 cents is good? Absolutely, it's good. Now, for those of you that remember on Tuesday, what I do is I take this number right here, 2.94. Let's just leave it at that. 2.94, and I times that by 10%. 10% is 0.29. So as long as this number is within this range, that is a acceptable bid-ask spread. Okay, it's an acceptable. But if it was let's say 80, it's 19 cents. That's still acceptable, but I would still rather trade something tight. So one of the things that you're going to learn is if I see two setups, let's say I look at JP Morgan, and JP Morgan's in an uptrend, and it's a bull flag. And then let's say I look at another stock that's in an uptrend, bull flag. Exactly the same picture. One of the things that I like to do is, because the decision is, which one do you trade? If you got two beautiful setups, which one do you trade? I trade the one that has the tighter bid-ask spread. If this is only 5 cents and that other one is 15 cents, I trade that one. Does that make sense, everybody? Does that make sense? Hey, Yachty, I didn't even see that you were here. Good. Absolutely makes sense, right? So all this is going to erase. I got a big old sloppy mess up here. So if you, it makes sense. Great. Let's erase it. Okay. So now, let's get back to this bid bad boy option chain. So now we understand bid and ask, and we understand the spreads. So let's go to over here. Okay. So right here, November 9/18. Let me tell you what that means. There are different options. This is called the option chain. Okay, this is the option chain. Now, there are different choices, right? So which one do you choose? Oscar, make sure you turn your... Oh, okay, you did that to me privately, but just make sure when you do type in a question or anything, it is to everybody. But yeah, I see your chat was on privately. Yeah, laugh out loud. But yeah, if you everybody make sure your chat's to everybody so everybody in class today can benefit from y'all's wonderful questions. Okay. So November 9, 2018. So let's take a stab at that. So what that means is this is when the option expires. So let's go over here and let's start right here. Expires. Because you're going to see in a minute that when we talk about the Greeks, okay, this is when the option expires. It expires 2018, which is this year. Let me move this one. November, which is this month, and the 9th of November, which is 3 days. So you see this little thing right here? This option expires in 3 days. When we get to Greeks, you'll understand more. Right now I'm just teaching the chain. These are weekly options, which means that this stock has both daily or monthly options and weekly options. Anytime they have weekly and daily, that means there's a lot of people trading this stock. That's good. So if we look at this next one, 18 November 16th, 10 days, right? And then 17 days, 24 days. That's how you look at this facade. It's really easy. Once you understand it, it's really pretty easy, but it does matter. Okay? It does matter. So if I click on this one expires December 7th, 2018, which is 31 days from now. Again, very tight bid-ask spread. Don't worry about which one you choose right now because that's immaterial. We're just learning how to read the option chain, okay? It's pretty easy, right? Everybody good on that now? So at least we're able to figure out this side of the chain, the option chain. See, look at this one. Good. This one right here expires 801 days. January 2021. January 15th. So this is what's called a leap. Don't worry about it. You can write it down if you want. But it's what's called a leap. And a leap just means a long time. Now, I don't know what it actually means, but it's called a leap. Leap, in this case, it's over, it's over, what, 3 years almost? I ain't trading no option 3 years long. But some people do, they'll buy these options, and I guess their IRAs if they have that approval, and they'll do it. Okay, so now we've knocked out this part. Pretty cool. Let's go to here now. Let's go back up to here. Okay, so when it comes to the option pricing, and the option pricing is this, okay, then there are certain factors that make up this price, and those factors are called the Greeks. Okay, not the Romans. The Greeks. And the option, I remember when I first saw that, they're like the Greeks. I'm like, what the heck? The Greeks? What the heck is a Greek? We have what's called delta, vega, theta, and gamma. Okay? Now I'm going to do my best to explain it. I mean, I know what they are, so hopefully I can explain it to where you guys understand. I'm pretty sure I can, okay? But what I'm going to do is let's just start with delta. And I've also pulled up something here, you can just find it. And I have to go through all my notes. I got so many notes, and this weekend I need to go through them. But let me go over here, and let me see if I can pull this up for you guys. Hang on. Okay, so we're going to go over here. And we're going to start with option pricing, the Greeks. Okay, we'll look at this, and then we'll do some explaining. We'll look at the actual chain itself, and we'll go from there. Okay, so the Greeks. Delta. Delta, sensitivity to the underlying price. So what we do is we're going to read it, and then we'll go look at it, and we'll make sure examples and make sure you guys understand it. So let's just start with the delta. Okay, so the delta is the most popular of the Greeks. Okay, it measures an option price's sensitivity relative to the changes in price of the stock. Okay, and it's the number of points that the option price is expected to move from each one change in the underlying. Delta is important because it provides an indication of how the option's value will change with respect to the price fluctuation. Okay, so the first thing we need to understand about this is right here is the option's price relative to the change in the stock. Okay, so let's go back to my trusted cheat sheet here, delta. Okay, you know what, I'm going to do this because I don't feel like typing, so I'm going to go here because I'm going to just pull out what's the most important. Here, copy, and then we'll dissect this bad boy because y'all probably didn't understand what the heck I just said. Okay, well, that's ugly. Okay, let's go here. Hit my microphone. Okay, so measures an options price. Let's kind of get this bigger here. 12. Sorry, guys. I just didn't feel like typing it, so here we go. Measures the options price sensitivity relative to the change in price of the stock. So if we go over here and we look at, okay, one of the things you can do is I want you to look right here at the layout. You can change this layout. Okay, now I have pre-built sets. So if you go over here and you click on that, it drops it down. So what you can do is these are the pre-built sets by TD Ameritrade. These are my own study sets. Delta, Gamma, Theta, Vega. Click that. Okay? And so it's got the Delta, Gamma, Theta, Vega. These are your option Greeks. The bid is the sell. The ask is the buy. So we're looking at Delta. So when I look at Delta, remember, Delta reflects the change in price. So if I look at this option that costs $310, okay, the delta is 0.46. Okay, just remember that. So it's 0.46. So let me write this down because I want to write this on my notepad and y'all can take notes with that. This option, okay, so if you notice the first thing on the option chain is I'm out here. This has 45 days till expiration. December 21st, 2018. Okay, that's the 45 days. And I'm going to look at the first strike out of the money, this strike. So I'm going to write that down. 21, December, 18, and then 110. The 110 is the strike. The strike price. The strike price, 110. And don't worry, I'll explain all this. Remember, the price of the stock is 108.88. Now, it's going to change, but write down 108.88 because I'm going to go to my notepad and I'm going to write 108.88. Okay, so if I go here, let's say JP Morgan. I don't know why that's so small, but let me change that to 12, guys. Okay, JP Morgan, 12. Okay, so the price of the stock is, I wrote down 108.88. And then on the option that we're looking at is the 21 December 18 110 call. Why is it a call? Because it's on this side. Remember from Monday's class, call, put. Okay? So far, is everybody good? Everybody good? Y'all just keep chatting in while we're going there for everybody else. Call, put. Call, what direction do I want the stock to go up if I buy a call? based on Monday's class, what direction am I forecasting JP Morgan to do? Go up. And obviously, if I buy a put, I'm hoping JP Morgan goes down. So if I see a bull flag setup, am I going to buy a call or am I going to buy a put on a bull flag setup? Call. And naturally, a put on the other. Great. So when I see a bull flag setup, I know which side of the chain I'm on. Okay? So let's go back to my spreadsheet. Or not my spreadsheet, just my little sheet in general. Okay, so I'm going to buy the December 18th, the 21 December 18, 110 call. And that price was, hang on, you know what, I didn't write that down. It's probably changing, but let's just write down 310, because that's where it's at right now. That is 310. So a minute ago, I think it was 200 and something. I think so. Does anybody remember, just out of curiosity, what it was literally just like 10 minutes ago? I think it was like 298, right? Or something like that? 268. Oh, you're right, George. Okay, so let's just look at this. And that was literally, let me see what time we're at on the clock. That was literally about 15 minutes ago. So let's check out this. The price of this option, if I want to buy it now, is going to cost me $310. The price 15 minutes ago was going to cost me $268. So that tells me the price has went up because the option increased in value. So let's just say I would have bought that a minute ago. I would have bought it at $268. It's now at $310. So I'm going to take $310 minus $2.68, and that is so good that this happened while we were in class. That is 42 cents. That's how much my option increased in literally 20 minutes. Which means if I bought it for $268 and I have 42 cents of profit already, 42 divided by 268, that is already, in 20 minutes, a 16% return. So you would have made a 16% return on your money in 20 minutes. Is that good? 16% in 20 minutes? Heck yeah, that's how you become rich. Beautiful. Okay? So, let's go down. So let's go back to the delta. The delta right now, I wrote down, I didn't write it down, but let's do this. So the delta is, right now, the delta is 46.46. And remember up here, the delta measures the options price relative to the change in the asset, which means as JP Morgan goes up, the delta is what is going to change the option price. So if the option price is $2.68 when I buy it, and JP Morgan goes up $1, because it represents for every dollar move, that means the option is going to go up by 46 cents. So, let's make sure we got that. Delta is the number of points that the option price is expected to move per every 1 point change in the underlying stock. So once again, if I buy, I'm going slow because I want to make sure you get it. If I buy this option for $268, and the JP Morgan moves up $1, the delta is 0.46. That means the option is going to go up by 46 cents, 3.14. So right here, that tells me that the option, this JP Morgan, has almost moved up $1. Is everybody good on that? Did I do a good job of explaining what delta is. Awesome. Yes, yes, yes. Good. Every dollar move in the stock, this is why delta. And back what it said on that chart, can you please explain that last part one more? Yes. Every dollar move in the stock, JP Morgan's at 108.88. So if JP Morgan goes up to 109.88, that's $1 move, my option is going to increase by 46 cents. So if I bought it for $2.68 and JP Morgan goes up $1, I could sell it for $3.14 and make a $46 gain, and I'm paying $2.68. So if I made a $46 gain and I paid $2.68, I would make a 17% return on my money. 17% return. And I only put up $2.68. So if I would have done 3 contracts, then I would have made 46 times 3, 130 something bucks. And if that stock moved up $1 in one day, I made 100 something bucks in one day. Okay, so that's delta. Go back and watch the recording. So it increases by the amount of what the delta for the stock is at 46 cents on. No, every option is different. You're going to see here, look at this. If I buy this option, the delta is 90 cents. So for every dollar move, it's going to go up 90 cents. But here's the difference. And again, I'll explain the difference in a minute. Look at the price. It's more expensive. I would have to pay $1,990 versus $320. Okay? So it's more expensive to buy the bigger deltas. Now, don't worry, you're getting introduced to options. But as you progress through the classes and the lessons, you'll understand it more. But anyway, right now we're focused on delta. Cool. I'll go over that in just a minute. Okay? So, the next thing that we're going to look at is what's called gamma. Gamma is the most complicated to explain, so I'm going to do my best. Let's go here, and let's look now at gamma. So let's first take a look at what our trusted cheat sheet says. Delta gamma. Gamma measures the sensitivity of delta in response to the price change of the underlying instrument and indicates how delta will change relative to each 1 point price change in the underlying. Since delta values change at different rates, gamma is used to measure and analyze delta. Gamma is used to determine how stable an option's delta is. The higher gamma value, don't worry, I'll explain all this in a minute. The higher gamma value indicates the delta could change drastically. Okay, now it says here at the money, don't worry about that yet. I will knock this down into layman's terms. Don't worry. But in the meantime, let's copy this. Go back to my little sheet. And I don't know why it does that. 12. Okay, so let's dissect gamma. Gamma is the most complicated for option traders to understand. But once you get it, I mean, it'll make sense. Okay, so delta sorted. Gamma measures the sensitivity of delta in response to the price change. So the question a minute ago was, the delta changed. Why? Well, the delta changed because of gamma. Gamma. Here we go. Let's try to explain this bad boy. So gamma. Gamma is 0.04 in this case, which means every $1 the stock moves up, we already understand that it moves up by 0.47, right? We're good with that. So let me write down 0.04 for gamma on my other sheet. So the gamma in this example is 0.04. Okay? Everybody good? We saw that? Everything easy on that? No problem? I'm pretty sure it's no problem because that's pretty obvious. Just taking a look at my futures trade while I'm in class. Okay, so here we go. Jane, I have no idea how long you weren't on mute, but I'm hoping the recording wasn't messed up. I like to look at the people in the chat and make sure they're on mute, because if not, it messes up the recording. And for those that go back and watch this lesson, which I imagine you're going to be going back and watching this lesson quite a bit, you need that recording. Exactly. Okay, so gamma. So gamma measures the sensitivity of delta. What the heck does that mean? Okay, so here we go. Remember, delta represents for every $1 move, right? Every $1 move in the stock, the option goes up 0.46. Well, what happens if the stock goes up $2, right? What happens if the stock goes up $2, right? How the heck do we measure that? Well, that is gamma. So if the stock moves up $2, then the delta, which was 0.46, again, there's other factors, now that option will increase by 0.46 plus 0.04 equals 0.50. So gamma represents what happens for every additional move. And gamma also changes. But gamma measures the sensitivity of delta. Okay, since gamma value, sensitivity of delta in response to the prices change in the underlying instruments and how delta will change relative to each 1 point price change. So every additional dollar that JP Morgan goes up, gamma adds to the option price to increase it. Okay? So, if you notice here, 4, 3, 2, delta, so JP Morgan goes up $1, it increases by 0.48. It goes up another dollar, then not only does it increase by the 0.48, now it's 0.04. Gamma represents the change in delta. In layman's terms, Jeff Moore terms, instead of that big old definition is, I'll just do mine. Gamma represents the change in delta. Right? The change in delta. $1 move goes up 0.46. $2 move, it now increases by another 0.04. So gamma represents the change in delta. Are we good on gamma? Anybody here? Guillermo, yes? Guillermo, are you the only one good on gamma? Yes? Sort of. Yeah, again, don't worry. I mean, you're just getting introduced to this, man. We're going to be, when we come to options, everything's like that. I know more. Yeah, I'm sure you know a lot more than you do. About right now, you probably know more than 99% of the people like in the world. In trading, anyway. That's gamma. Gamma's, like I said, you don't need to worry about it. You just need to understand what makes up the pricing model of the Greeks. I could care less about gamma. And I'll be honest with you, when I trade options, I never even look at the gamma. All I focus on is which delta, and I have my price targets. I have my stop loss. That's all that matters to me. So now let's look at theta. Theta. Okay. So number 3 is theta. Okay, let's go take a look at what this one says about theta. Theta. Theta measures the time decay of an option, the theoretical dollar amount that the option loses every day time passes. That's all I need to know to keep you guys from freaking out. I don't know why I keep showing this damn thing at the bottom. Stupid. Okay, let me make it bigger. And I'll end up putting this cheat sheet later on the website so y'all have it. Again, I encourage you to make up your own cheat sheet. So let's go look at theta. Theta measures the time decay. One of the things you need to understand about an option is options have what's called as time decay. I want you to think of an option. These are my little side notes my mentors told me. think of an option as an ice cube. What I mean by that is ice cubes melt, right? Ice cubes melt, and they get down to nothing. Options melt. They're time decay. They're time decay. This is when the option expires. 10 days, 3 days. It melts. Okay, it melts. So you think of it as an ice cube. Time decay is hurt you. When you buy an option, when you buy an option, theta hurts you. Theta is how much your option loses in value every day. See? There, how it loses every day time passes. You not only have to be right on the direction, but if it takes a long time, theta hurts you. So if I get into a bull flag trade and it goes like this, and time passes, that option will start to get hurt by theta. We don't like theta when we buy options because it loses value every day. When you buy an option, theta hurts you because option prices melt. Okay? Theta hurts you. That's why when we buy a call, it has to move fast. We also have rules that if it doesn't move within a certain amount of days, we get out. Because we need the what? The momentum. Because if we don't get the momentum, we get hurt on theta. Let's go take a look at theta. Theta is, see how it has this little minus symbol? See that little minus symbol right there? Minus 0.04. So, minus 0.04. So let's go here. We're going to go theta, and it is minus 0.04. Which means every day, not every dollar move, every day, every single day that passes, our option is decreasing by 4 cents or $4. Remember, I bought this option for $2.68. Every day that goes by, my option decreases. I lose $4 a day every day for holding this option. That is what theta is. It's like an ice cube. Again, the key thing to understand is theta hurts you when you buy options. Delta is your friend. Gamma is your friend. Theta is not your friend. Does everybody understand that? I want to make sure we get through this class because we have 10 minutes left, so I want to make sure I get through it all. But is everybody clear on theta? Hurts you? Yes. Good. Okay. Let's go to the last measurement. It is Vega. What the heck is Vega, right? Let's go to our cheat sheet. Let's see what they say. Vega. Vega measures an option's sensitivity to the changes in volatility of the underlying that represents the amount of the option's price in response to 1% change. Okay, so let's just do this. I'll sum this up in a nutshell. I had just looked at this document. I haven't studied it. So let's go over here. Let's go to Vega. Vega. You gotta learn it more than you would ever learn in like a school. You don't understand. Well, you probably do understand. Okay, so here we go. Vega. Vega measures an option's sensitivity to the changes in volatility. What the heck is volatility? Right? Volatility is, volatility is what makes us money. So here's the key point about volatility. Volatility is basically called, it's this indicator right here. I told y'all to look at the futures the other day, and it was called the VIX, backslash VX. Right here, this is the volatility index, VX. So if you're looking on profit charts, the volatility index is the VIX. This is what's called the fear indicator. When the VIX goes up, that means the market's going down. Okay? So the VIX is the opposite of the market, because as the market goes up, people aren't scared. But when the market goes down, people freak out. They panic, they sell, they buy puts. So the VIX is the fear indicator. So if I go here and I look at SPX, and I'm going to go back to 20 years. 20 years. Right here in this time period. Now, this is the monthly chart. So if I go to weekly, does anybody here remember 2008? The massive crash of 2008. Yes, I'm sure you remember that, Cherie. Absolutely. The stock market took about a 40% dive. Look at that. People lost everything. Now, I'm going to go back to the same period, and I'm going to look at the VIX. The VIX represents people buying protective puts on the VIX. Protective puts, they want the stock to go down. So let's go look at the VIX during that same time period. And I'm assuming that the VIX would be going up. That's a mess. I get it. So let's go here to 2008. Look at this. 2008. This is the weekly chart. Like a rocket ship. The VIX spiked from like $18 up to $80. The VIX, the volatility, went up. Hardcore. Okay? So, back to Vega. Vega measures the option sensitivity to the changes in volatility. So, whenever I buy an option and the stock is going up, there's not much volatility because, again, it's just going up. People aren't scared. But as soon as the market goes down or the stock goes down, volatility expands. Think of volatility as a balloon. Think of volatility as a balloon. You're blowing in the balloon, you're blowing it up. You blow up the balloon, it gets bigger. You blow up the balloon, it gets bigger. You blow up the balloon, it gets bigger. What happens to a balloon if you continue to blow it up? Pops. It pops. It blows up. So that's the way Vega is. As the market is going down, volatility expands. Okay? Volatility measures the option sensitivity to the changes in volatility. And it represents the amount of the option price changes 1% in volatility. So every percent the volatility moves up, you're going to see in a minute what happens to our option. So we go back here to the option chain. Oops, what was I on? Oh, JP Morgan. Okay, good. And almost here. Look at the Vega. The Vega. Right? The Vega is 0.15. So whatever change, so if volatility increases by 1%, your option will go up 0.15. But when the option's going up, volatility is pretty much non-existent. But it is a factor, volatility. So, if Vega increases, the amount of your option increases. Vega's volatility. But when we buy options, volatility is, when you buy options, volatility is the least measurement of all. Because when you're buying options, the stock's going up, people aren't scared. You know, you're not going to get that 1% change in volatility. Again, don't worry about it. You just need to understand the Greek. Vega represents volatility. Volatility. So here in this example, let's go back up here. I'll make it bigger. Vega was It's just the keys. All you need to know is it measures the sensitivity to the change in volatility. The volatility for this one that we were looking at is 0.15. So if JP Morgan increases by 1% in volatility, our option will increase by 0.15. Okay? So let's do this. I want to make this to where it's all on the one page. Okay, so we have the option Greeks. We have delta, represents the price change. We have gamma, represents the change in delta. Theta is time decay. And vega measures the volatility. So if I go over here to this, I can actually go up here to what's called this. It's called the Theo price. Check this out. The Theo price, this is called the theoretical pricing model. So if I look at a theoretical pricing model, remember it's still the same cost. Now it's at $325. If we bought it at $268 this morning, we were already up $80 on this option. $80. And it hasn't even been 2 hours. But this theoretical pricing model, this tells me what the price theoretically would be if certain things happen. So it's going to race, but I'm going to look right here at this. This is why TD Ameritrade is the greatest platform in the world. Nothing will ever beat it. So if I go here, I can forecast. Let me go to reset. So if I have a price target, let's say, for example, and we'll finish on this one. Let's say, for example, I have a entry at $109, a stop at $107, and a target, because one thing about option trades, we always have targets. Let's say my target was $115. So how much is my reward? $6. My risk is $2. Everybody cool? My reward is $6. So I can just kind of theoretically go over here and say, okay, if I buy it for $3.20, and this stock goes up, dang it, was it $6? I didn't write it down. Let's say $6. That's the target. You can go up here to this theoretical price and say, okay, so today's 11/6. Let's just say that in 2 weeks, so by 11/20, so November the 20th, so 2 weeks, that my stock goes up $6. And I hit enter. It can tell you that your option, which is $3.15 right now, will be worth $6.20. So if I buy it at $3.15 and the stock moves up $6, theoretically it'll be my option will be worth $6.21. So if I divide $6.21 by 315, that's 306 or 3.06. That's how much my option increased. So if I paid $315 and I got $306 in profit, you divide $306 by $315, that's a 97% return on my money. So if the stock goes up $6, I'm making a 97% return on my money. If I buy it for $100 a share and it goes up $6, that means it's going to go to 106. My profit is $6 a share. So if you divide $6 into what you paid, which is $100, that is a 6% return on my money. So not only did I pay less, instead of making 6%, I made 97% return on my money if the stock goes up $6. Is that cool? It's amazing. You guys should be screaming in the chat. This is the most amazing thing ever. It's so big. So if you can predict bull flag and set a price target up here and it goes to your price target, it's dinner time, baby. That's the way it is. Now, one other thing, and then I'll finish at that. This right here, volatility adjustment. So let's say volatility goes up by 1%, right? Because, again, volatility is Vega. Every 1% move affects the price. So instead of what we saw a minute ago, which I didn't write it down, it's at 630. But Vega doesn't affect it much. So look at whenever I click the button, I want you to look over here as I click the button. It's just every 0.10, so 10% only moves at $1. But look at this. If I move it from 6 to 7, watch this number right here. Boom. No, 6 to 7 will be 7. Look at how it jumps. The most important thing when it comes to trading options, and this is the last thing that I'll discuss, is delta. Delta is what matters the most. Delta represents the price change based on the movement of the stock. You have to pick the stock's movement. If you do that, you will be great. Let me save this because this is something I want to add, and we're going to, hang on a second, guys. Basic options, and then today's class was 11/6/2018. We'll go up here to our trading part-time. I got 2 trading part-time master classes. When was this one created? We'll go to here. Go to here. Here. Of course, I can't. Hang on a second. Boom. Saving that, I'll add it. Okay. So anyway, guys, that is the lesson for today.
All right, everybody. Hope you enjoyed today's video lesson. And we talked about a lot of stuff. We talked about the option chain, the big, the ask spread, the options leverage, the Greeks. I threw a lot of information at you. So if you didn't get it all, go back to this video lesson and watch it again and again and again, okay? We talked about why all of this matters, okay? And it all does matter when it comes to trading options. All right, everybody. Until next time, this is Trader Jeff Moore, author of the book Trading Part-Time, CEO, lead instructor of the Trading Part-Time University, and we'll see you in the next